This video is going to share a moving average crossover trading strategy that can be used in the stock market. On my screen here is a price chart for Apple, and each of these price bars or candles represents 1 day of price activity for Apple stock. You'll notice I also have two different lines depicted on my screen. These are two different moving average lines. This blue one here, it's a simple moving average set for 20 periods. So in other words, it's a 20-day moving average line. And it's not an exponential moving average, it's a simple moving average. For the purpose of this particular strategy in this video, we're using a simple moving average. For this other line that has a purple-ish color, it's also a simple moving average, but it's a 9-period moving average. So in this example, the 9-period moving average is the faster moving average. And what that means is as prices change, this purple line, the 9-period moving average, will respond more quickly to change its course to match that price activity than the slower moving average. The slower moving average, the 20-period in this example, covers more historical bars, and that offsets to some degree the most recent price activity. And therefore, the 9-period will respond more quickly to current changes in price than the slower moving 20-period one will. Now, we've seen a lot of different moving average crossover strategies promoted before. And one that we see a lot is when the faster moving average crosses over the slower one, that can be a buy signal. And you can see here, again, the faster one is this 9-period. It's below the 20, below the slower one, and then it crosses right here. And so after it crosses, according to those ideas, that would be a trade signal to buy. And so, after this price bar is complete, after this day of price activity is over, it's officially crossed over right here. So that could indicate that the buy signal would be right here. And in this case, buying right here may have resulted in some nice profits. So that is a strategy that we've heard before. But one of our specialties here at Stock Market Guides is doing our own research. Rather than just, hearing somebody tell us a trading strategy and assuming it works, we want to know for ourselves what happened historically. And so what we do is we do back testing. And we've done thousands and thousands of back tests on different trading strategies, including moving average crossovers. And we go and we look at every stock and we see, for a given trading strategy, how might this have performed historically? And we try to identify which ones may have performed well and which ones might not have. And we did a lot of tests of this exact strategy. And although it looks good on the screen for this one example, when you look across lots and lots of different stocks and look back over the entire course of time, it doesn't look like it may have performed well all that often. And so we actually like a different strategy. And again, this is based on our own research. And the strategy we like is actually to buy when the faster moving average line crosses under the slower one. This is on a daily chart, and this is what we're going to teach you right now with this strategy. So the specific rule for the entry of this trading strategy is when the 9-period simple moving average crosses under the 20-period simple moving average, that's considered an entry signal. So let's look at this exact case. These are each price bars for an entire day's worth of price activity. At the end of this day, that is the first time where the 9-period moving average is under the 20-period after previously being above it for quite a while. So at the end of this day is when the signal is confirmed. Therefore, the entry would be the next day right here. Now you can see that in this example, on Apple stock here for this particular part of the chart, this trade would have taken some heat initially. So we'll talk in a moment about what exactly the exit criteria are. But depending on where you set your stop loss, it's possible you could have hit the stop loss here. Depends if you had a really tight stop loss or if you gave it a lot of room, or maybe you had no stop loss at all. But if you didn't have a stop loss, or your stop loss was further down than this right here, then you can see this may have led to some profitability. Again, it all depends on what your exit criteria are. So we will go ahead and define that now. This video is intended to share a specific trading strategy, and although you can use whatever you want, it's just going to give a firm idea that you could go based on. So we're going to say the time limit for our trade is going to be 2 weeks. So from the time of entry of the trade, the longest we'll hold it is 2 weeks. And so that would be, right around here. That's just for this specific trade strategy that we're sharing. We also are going to set up a profit target and a stop loss. And we're going to set the profit target to be 2 ATRs away. Now, ATR, it stands for average true range, and it kind of represents what the recent price activity of the stock has been. It's a measure of the price volatility of the stock in the last couple of weeks. And if you look here, you'll see there's a number that it changes as I mouse over different bars of the price chart. And at the entry, which occurred right here, the ATR was 2.97. Let's just call it $3 to keep it simple. So the profit target for this trading strategy will be 2 times that amount. And it will be that amount. So 2 times 3, and to keep it simple, we'll call it 3. So 2 times 3 is $6. And we're going to say it's $6 away from the entry. So if you look at my mouse right now, you can see that there's a line coming out of it. I'm kind of tracing the line. And if you follow that all the way to the right, you can see what the price is at the entry. It's about 147. So if I'm taking 2 times the ATR, so 2 times about $3, that's $6, I'm going to add that to the price at my entry. And if I got in at at the opening bell of the next day, that means my entry would have been about $147. That means my price target for my profit is $153. It's 147 plus 6. You can definitely narrow it down to the penny if you'd like. For the purpose of this video, I'm just simplifying it. And so we have a profit target now. It's 2 ATRs away. For the stop loss, let's set it to be the exact same, 2 ATRs away. So that's $6, but this would be $6 below the entry. So if the entry is 147, that means the stop loss would be $141. So if this is the entry, and we know we have our 3 conditions for exit, either a stop loss at 2 ATRs away, a profit target at 2 ATRs away, or a time limit of 2 weeks, let's see how this trade would have performed in this specific example. So assuming you had actually gotten in right at this price of about 147, you'll see the price went down. It did not get all the way down to 141. The stop loss would have been about right here with our 2 ATR stop loss. You can see then it goes up immediately, and it did get past $153. That would have been our profit target. And so for this specific example with that exact trading strategy, the indications by looking back at history are that it may have hit that profit target. In fact, it may have gapped up above your profit target and given you an oversized profit. If it hadn't hit the profit target or the stop loss, you could have held it for 2 weeks and then just close it at the prevailing price 2 weeks later. So that's just one example. In this example, that trade may have turned into a profit, but there's certainly no guarantee that this is going to be a profitable trade setup every time. There's no trade setup in existence that is guaranteed to be profitable every time. There's all sorts of uncertainty in the stock market. This is just one that, based on the research we've done, we would feel comfortable pursuing a trade idea like this. Speaking of our research, we've done tons of research, as I said earlier, and we have developed a service that we offer to people that offers trade alerts when opportunities come up for these moving average crossover trades. And they specifically look at history. So when we send a trade alert, we provide the history of success for that specific trade idea. So it explains exactly what that moving average crossover strategy is that's being alerted, what the stock or option is that's being alerted, and it indicates the exact win-loss record historically from the back tests that we ran on that strategy for that stock. You can check that out if you'd like. It's at our website, stockmarketguides.com. If you have any questions about trading strategies, moving average crossovers, or anything else related to the stock market, we would like to hear from you. Our email address is support@stockmarketguides.com.